If you order something online today, there is a high probability your package is currently stuck in a physical traffic jam. Global e-commerce volume is simply moving faster than the conveyor belts and human hands meant to manage it. Retailers are facing a dual threat to their margins. Consumer demand for rapid delivery requires massive inventory scamming, while warehouse labor inflation and staffing shortages make traditional fulfillment centers increasingly expensive to operate. AutoStore's solution is a high-density, grid-based robotic system that eliminates wasted warehouse space. They currently manage a global fleet of 92,500 robots across 2,000 different systems. The company's path to expansion is now clear of major legal hurdles. Following years of litigation with competitor Ocado Group, the final settlement installments were completed in 2025, removing a significant layer of risk for investors. But while the engineering is proven, the real test is whether this physical efficiency translates into a resilient financial machine. AutoStore's Q2 2026 earnings report suggests it does. Top-line revenue for the quarter reached $192.1 million, surpassing market expectations. That represents a 43.4% revenue jump compared to the same period last year. It indicates that even in a complex economy, the demand for automated storage and retrieval systems is accelerating. This chart shows the company's quarterly order intake. To support their $700 million full-year revenue guidance, AutoStore needs a consistent pipeline of commitments. The Q2 data shows order intake rising to $217.6 million, nearly 45% growth year over year, providing visibility for a strong second half. Perhaps the most significant figure is the 72.2% gross margin. By retaining over 70 cents of profit for every dollar of hardware sold, AutoStore is demonstrating significant pricing power over its competitors. These margins suggest that while AutoStore ships physical robots, the business behaves more like a high-margin technology platform than a traditional equipment manufacturer. Those margins are flowing directly to the bottom line. Net income for the quarter rose to $50.6 million, up from just $11.3 million in the same quarter last year. While earnings rose, debt fell. AutoStore reduced its total debt by $46 million this quarter, using cash generated from operations to pay down its revolving credit facility and lease liabilities. This scale illustrates the company's current leverage, achieving a net debt ratio of just 0.3x with a $104 million cash reserve. This liquidity acts as a buffer, allowing management to fund growth initiatives without tapping expensive external capital markets. With a solid cash position and a price-to-book ratio of 2.6, the board has authorized a $75 million share buyback program. This allows the company to return surplus capital to shareholders throughout the remainder of 2026. With over $500 million in total liquidity and minimal net debt, AutoStore's balance sheet is structured to survive a downturn in consumer spending. For a company with optimized margins and low debt, the next challenge is finding the scale to maintain this growth trajectory. On August 13th, AutoStore announced a global strategic supply agreement with Amazon. While this agreement doesn't include immediate purchase commitments, it establishes the formal framework for Amazon to procure AutoStore systems globally. It positions their technology inside the world's most sophisticated logistics network. This framework follows an aggressive year of R&D. AutoStore launched 14 new products and features over the last 12 months, expanding its software capabilities and hardware modularity to handle a wider range of retail use cases. Securing a global framework with an operator of Amazon's scale suggests that AutoStore's grid-based robotics have met the reliability requirements of the industry's highest volume fulfillment centers. AutoStore currently sits at the center of the push for warehouse automation, operating a business model that generates significant cash while solving a critical labor constraint. This backlog chart shows that even before the Amazon agreement begins to scale, AutoStore has a massive volume of work already committed. That $596.1 million backlog serves as a safety net, ensuring the company can maintain operations regardless of short-term fluctuations. With a record backlog and a new path into Amazon, the company is positioning its robotics as a core layer of modern e-commerce infrastructure. Does this financial profile make AutoStore a standout in the tech sector? Let us know your take in the comments, and tell us which company we should tear down next.